Hi, and welcome back to Channel 11. I'm Ken Shinoda, your host today. I've got Jeff Sherman with me. Today is December 16th, Friday, quadruple witching.
Yeah.
So watch out there.
Yeah, what better day to come and talk about equities,
Yeah,
right?
so we're here for, I guess what we've been calling, when Jeff comes in, we've been calling it What Now? Everyone calls it the market update, but we thought funnier, What Now? But today we're going to focus on equities. And so it's obviously been a rough year for equities, a decent month. The last 30 days, you've seen a little bit of a relief rally, albeit that seems to be fading here in the US at least. And you've got global equities down about 15%. But, certain pockets have been outperforming. Value's been outperforming growth. Europe, which is a little bit more value-y, has been outperforming. Negative returns for fixed income too. Off the lows, at one point the ag was down kind of mid-teens. Now we're only down about 11%.
Like you say, it's only. Right?
Only, yeah. It's and we'll see in a moment, worst year for bonds ever, going back to 1978 when the data for the index started. And the things that have worked have been the dollar. It's been a big trade for the kind of momentum followers, the macro funds, and commodities, right?
Yeah, and that's still a strange thing, right? There's not many periods in history where you have a very strong dollar and you have commodities doing well. And obviously it's a supply chain issue. And when I say supply chain, it's the underinvestment in the commodity space for a long time. And so I think, what's interesting too about the commodity side, even though we're here to talk about equities, is that let's just talk about, the reopening of China, right? Yeah. If they actually do, relax the zero COVID policy, just the underinvestment you've seen in that area for a while. We saw it in the industrial production numbers that came out this week from China. It's one of the lowest readings we've seen in many decades. And so, I still think, there is room for the commodity market to run. And if you look at where we are, like with oil, right? I mean, we're near the lows of the year. We did set lows of the year. I think it was last week. Maybe it was earlier this week. It all kind of blends together at this point, just how volatile things have been. But, for people thinking about, just kind of, if you're wrong on the recessionary risk and everything too, potentially commodities had that last push before it pushes us into kind of somewhat of a global recession. And a lot of that is predicated upon the reopening of China. So.
Yeah, Jeff Curry from Goldman was been out recently, kind of still really bullish. He was bullish going into this year. Yeah. And he's even more bullish. A lot of it just on that kind of lack of supply. Even with the oil, we have a lot of lack of supply.
Yeah, and I mean, look, everybody's focused on the energy crisis in the Eurozone, and so far they've been able to weather the storm, no pun intended, with that. But it's going to be challenging because we haven't seen this really investment in that area, and so even though commodities have kind of suffered in the last let's call it month or two, I think you're getting better to another entry point to do that, and so. As an allocator, thinking about equities, bonds, I think commodities should still be there for the what-if scenario too. Yep. Even though you're going to have volatility on that, and again, we'll talk about the recessionary risks that are out there. But I do think that the commodity market still is something that belongs in a portfolio, and especially where we are with this recent performance, I think it's something that investors really should continue to monitor.
I agree with that. All right, so now let's look at the bond market. This is we did a episode of about opportunities in bonds about a month ago, so we're not going to spend too much time there, but this is one of my favorite charts that we've put together here. This shows the return of the index going back to when daily data started, 1978. And the bars going up, positive returns, bars going down, negative returns. The bars in the beige, or is it like gray color, that's years when rates rose. And there's many years when rates rose and returns were actually positive because you started with higher nominal yields. We started with the lowest yields ever back in 2020, 2021. And so as rates rose, we've had the most negative year the index has ever had here in 2022.
Yeah, and I think it's pretty interesting too, because when people think about the pain in the bond market, everybody references 1994. And just look how minuscule that downdraft was in 1994 relative to this year too. And also you have those dots on there that show the intra-year drawdown as well. And it's pretty amazing that just the magnitude of what we've seen. And again, it's math. A lot of people call it bond math. I call it math, right? Yeah. But at the end of the day, I think, as you guys spoke about a month ago, just the interesting opportunity set today. And so, valuation looks relatively attractive. We've talked about the mix of credit and rates at this point in the cycle. And so I call it the old school way of investing in bonds again. You get the support from the rate side of the equation, right, for the risk-off environments, and it can actually work at this point in time. But as you point out, all the time, credit is still relatively attractive, even if we have some recessionary pressures.
That's right. But we spent a lot of time on bonds. Today is all about stonks, and this is the performance across sector. So as we talked about earlier, it's a mixed story. Not everything is down. Not everything is down a lot. Value type assets, defensive assets have been outperforming. So through security selection and obviously sector selection, you can find some bargains out there, and you can create, I think, better returns than just owning the index perhaps.
Yeah, and if you look at your bars and you look at the right-hand side of the chart, it's not shocking to see which ones are down, given the previous slide, right? It's the interest rate sensitive sectors, and people think of, communications and tech as kind of being long duration, rightly or wrongly, but they are highly sensitive to interest rates because the multiples were so high coming into this, and they were predicated on that. And I know we'll talk more about that. But even things like momentum, you would think in a market like this that momentum would have done significantly better. But we've had so many just like whipsaw natures across the market too. And remember, momentum, that factor is actually single stocks. It's not taking the momentum of the index. And so, I think even though it's been a challenging year or two, we all needed to reset a little bit in valuation. And I know we'll go through this more, but I'm just still amazed with the performance of the energy sector too, right? It's continued to perform even with oil prices relatively flat this year. And some of that's margin, some of that was the disdain for that sector of the market. But again, there always seems to be sector opportunities out there in the marketplace. And that's what I would like to talk about later on.
Energy during like the COVID days was one of the big laggards out there, right? We got that crazy negative. I took a screenshot of my Bloomberg screen when we got to that negative oil print.
Well, Sam Lau was trying to put it in his, he wanted to store it in his swimming pool, right? He was trying to figure out how to get those negative oil.
Gasoline.
Right, and I was like, I don't know if your neighborhood's going to like that. But also, this chart is just really a reversal of what were the strong performers during COVID, right? So essentially, you've had this kind of reset in valuation, and as we say in markets, they tend to mean revert over time, right? Especially on a valuation basis.
And we're going to see that on the next slide. Just note that a lot of the cyclical assets also underperforming on the right-hand side, consumer discretionary, consumer services, and a lot of the defensive assets like utilities and healthcare have been outperforming. Here is cyclical versus defensive. I had Barry Bannister on here, I don't know, the beginning of last year, and
he's from Stifel,
From Stifel, yeah. And he was noting that whenever the cyclical versus defensive gets to like 2+ standard deviations relative to the defensive, when cyclical gets that high, you usually have a mean reversion. And lo and behold, kind of like magic, it happened, right? Sometimes the charts really do tell a good story through time. It's been quite aggressive, but you see that during those recessionary time periods, it gets all the way down to about 2 standard deviations below. And so based on this, it looks like we may have a little bit more room to run. Right?
That's right, absolutely. And as you say too, like in a kind of recessionary environment, and it's on everyone's lips today. And so maybe once again, if you recall, remember like late 2019, even before COVID began, everybody was talking about a recession. It's like, well, if there's going to be one, it's the most telegraphed in history. And I think it feels that way once again. But that said, I think being a bit defensive with the equity portfolio after the run we've seen in kind of stocks over the last, let's say, 4 to 6 weeks, right? Since we've had those 2 inflation prints, I think, you probably do have a little bit more room to run on the defensive side.
Looking at some of these relative valuations for, seems like a couple of years, we had been talking about the finally time for value to shine, especially as potentially rates rise, and that would be a headwind for growth. And it worked for a little bit. I think it was in 2021, and then you saw growth rally again, and then now it's really working. So kind of stick to your guns. Don't get whipsawed by some of the moves. If you had stayed with value, it's worked out pretty well this year.
Yeah, and I think that was one of our calls early in the year too, was like continue to focus on the value trade. Because what we've seen is really this growth versus value was kind of the opening, the closing, the opening, the closing, all that stuff related to COVID as well. And then what we've seen kind of just with the economy rebounding and somewhat of a return to normalcy or whatever we call this now, I'll call it the new era. All of a sudden, you had this reversal again. So we saw a lot of the growth companies also not just being interest rate sensitive, but also mismanaging inventories, right?
Yep.
Mismanaging the business. Look at Amazon, with
Target.
how much like warehouse space they ended up leasing and they've had to put back already. And so I think a lot of this is the reset to say, okay, we aren't going to return to normal. We're not, or what was pre-pandemic normal. We're not going to stay in this weird kind of like quasi-COVID world. And so I think this is what you're seeing here. And I mean, just look at how pronounced that valuation change is.
And we see similar stories as we go to the international world. This is U.S. versus Europe. Europe's indices are more value-ish in nature. They don't have as much tech and growth in them.
Right, and if you think about it too, everybody knows the pain in Europe, right? Everybody says the recession's coming there, how troubled it is, how challenged it is. I mean, look at what the ECB was raising rates this week and just saying they're going to do 50s for a prolonged period of time. I don't remember what Ms. Lagarde said exactly there. I'm kind of paraphrasing. But even through all of that, Europe has outperformed the S&P 500. And so I like to talk about three things, right? There's fundamentals. Fundamentals take time, right? That's what we all think about in terms of valuation. But you can't day trade fundamentals, right? Then you have kind of the technicals part of the market. That's momentum, that's money flow coming in there.
Yep.
And that drives the market as well. But at the end of the day, it's that component I said, it's money flow that drives it too. And so what you've seen is a renewed interest in Europe as well, especially as bond yields have reset. That part was much more cheaper.
Yeah, and the currency has gotten hurt. So
Right.
from a dollar investor standpoint, you're buying low,
Right.
both on valuation standpoint, but also with a strong dollar.
Yeah, absolutely. Yeah.
EM, something we've been talking about for a while here, that it looks cheap, it keeps getting cheaper, kept getting cheaper, got cheaper again, but really that you need that dollar to turn over to really get tailwinds for EM. And we may see maybe one move higher in the dollar, but it seems like we're towards the end of that. So that's one of Jeffrey's big conviction trades for the long run.
Yeah.
Is EM versus the U.S.
Yeah, my only reticence about that trade in the short term is one, the run. Look at the chart.
Yeah.
I think you should declare a little bit of victory here. And my concern is that if the U.S. has a recession, it tends to have the flight to quality. So when that happens, money will pour into the U.S. Treasuries will be the asset. That's the demand for dollars. And I think you get one more push in the dollar. And so, for people who don't have this allocation today, I think you need to be a little patient. I think you need to be kind of half of where you want to be just because of that dollar move. And then ultimately, once we get that, if we get that move, I think that's when you really want to pile into non-dollar assets with an overweight to emerging markets.
Okay, so we kind of looked at some relative valuations through time, but let's just talk about valuations today across the different markets. And forward PE is the main one the market looks at. And this shows you the current PE on the left-hand side, the high that we saw in 2021, how much it's reset since then. You can see some of the European markets way down relative to their own PEs in 2021. And here you have the 20-year median. And relative to the 20-year median, you can see that the European areas and Japan look cheap. And as you go to, I guess EM looks neutral. And the US, I don't know why anybody cares about Switzerland here, but the US being on the expensive side, right?
Well, I mean, we cared about Switzerland for a while when we were watching the World Cup, right? There was a few games in there with that. But jokes.
I'm just saying it's a small
No,
equity
it's a
market.
small, that's why I always say, too, when people worry about the Swiss National Bank, I'm like, what's going to happen there, too? Right? I mean, I guess the demand for chocolates and watches, will always drive it. But when you think about it and you look at these kind of versus the median, this is just reeking of the cheapness, too, in these markets. And look, it's predicated on the E. You got to get the E right. But still, on this valuation basis, it does still make the U.S. look a little more rich relative to other areas. And again, it's the currency, right? The currency is really driving this. And so I do think that, you do still need to have these positions. And like we run strategies that focus on the Eurozone on the equity side. And, they've done quite well this year. And so from that perspective, I think that you still want to have some of that, and it's that fear, right? It's that fear of the eurozone and the recession that everybody says is forthcoming.
Yeah. So what's really we've seen in the equity market, and many in the financial media have been talking about this. It's really been a resetting of the forward PE multiple with real yields going higher. So here, this is a chart from Goldman. This is through December 8th, and it shows you inverted real yields. So taking nominal yields and stripping out the market's expectations of inflation to get what that real yield is after inflation. That's obviously been going up. And as that's gone up, forward PE multiples have come down.
Right. And some people really struggle with this relationship, but it's very simple. Why would you care about the real yield, right? So if you think about it, when we talk about the multiple on the S&P, you can invert that, right? So if you invert that, it's called the earnings yield on the S&P 500. So if I can get a real yield in the bond market, and again, these are like tips, right? So they're government guaranteed, you should have some form of premium on the earnings yield of stocks because they're risky, right?
Yeah.
And so it's not shocking that this relationship does hold through time. And we've seen a massive reset in yields. And so obviously the multiple needs to come down. And so I think, again, depending on the path of this real yield environment, and look, Jay's committed to fighting inflation. He wants to, get that part of the equation down. And so, I think at these levels, the S&P 500, as you think about it on the cap-weighted basis, does still look a little rich, right? Yeah. And again, we can talk about the earnings side of the equation, but this is why I think we just stay range-bound. I think you're going to have to be able to trade the range a little bit if you're an S&P 500 investor. Obviously, as you showed earlier, there's ways of trying to enhance that through sector rotation, through factor investing and the likes.
Yep. And so, having been a story of a drop in the forward PE, really everyone's been talking about is the E. Like what's going to happen with the E? You got the Mike Wilsons of the world he's been pretty.
He's had a great year.
He's got a good couple of years, and
everyone's
waiting for the E to come down. And here you can see this is the historical each year going back here to, I guess we go back to 2011 on this, and shows you the operating earnings annual growth forecasts. They typically tend to always come down. Except for 2021, which was kind of an insane year.
Well, also 2018, right? And you may scratch your head there. And I've read Jim Bianco's research forever. He's always talked about this in my career, it feels like. But look at 18, like what happened there? And it's like, oh, well, there's tax cuts, right? So that was the big change in 18 on the E. But notice here, the earnings growth tends to be relatively slow. And so again, these are estimates. They may come down a little bit. They tend to come down as time goes on. But again, this looks normal, right? This looks relatively normal. And again, their expectations, so maybe it's, that group think and we're anchoring on off all that. But ultimately, if you see here, outside of 2020, we have had really relative earnings growth, right? And 15 was a little challenge. We know the credit markets were rough in the second half of that year.
It was kind of a manufacturing energy slowdown.
It was industrial. It was concentrated in the commodity space as well. And look, there was a lot of bankruptcies in the energy complex. And what happened at that point in time too is, remember, those companies delevered. Right, some delevered through bankruptcy, some was through acquisition, but the energy complex has gotten its house in order, and so I think that's why you've seen some of the strong performance this year, and I think that also bleeds over to the high yield market. And like, even though we're supposed to talk about stocks here, but high yield's the low beta version of stocks, and so when I look at that part of the market too, what you find is that looking at spreads, and they're not signaling recession because, again, a lot of the pain historically, at least in the last decade,
had been
or so,
energy.
Yeah, absolutely.
Yeah. So talking about earnings, let's go back through time. Here's another chart from Goldman. Thanks, Goldman, for the nice slides. And they were in the headlines today because talking about laying off a bunch of people.
Yeah, and it's funny how that gets us headline. It's like roughly 8% of their workworce, but
they do that every year.
Yeah, that's what I was going to say. Isn't that kind of the policy of churning, the lower performing earners? And so it's amazing how when the bears are out and everybody's so negative.
It's a good headline.
It's a great headline, and it drives such negativity. It's like, well, Morgan Stanley's going to have to follow, and everybody else going to have to follow. And it's like, I don't know. I mean, to me, so far the job losses have been very technical. tech-oriented and financial
Tech
services.
and finance, yeah.
Right. I mean, look, all of our earnings are down, right?
It's a recession of the vests. So
Yeah, so the bro vests are having the worst time that we've seen out there. So bro vest recession, you heard it here from
That's
Ken
right.
Yeah.
Okay, so this is median EPS decline during recessions going back to post-World War. And you can see that the median decline is about 13%. Obviously, it was worse in '08. And the expectation right now, I guess at least from Goldman, is they think we're going to see about an 11% decline in earnings in the recession scenario.
I'll take the under on this. I think it looks worse. And the reason being, look at the trend of the last few recessions too, that how hard that the earnings side has gotten hit. And you could say, well, okay, what about 2020? Right? It didn't get hit very hard, but think of the stimulus too.
Yeah.
I mean, people criticize the money going to people during that and saying people are at home playing video games, getting their check. But think of how much we bailed out corporate America, right? We sent so much money, and like 3/4 of that first stimulus went to corporate America, and so I think that's why you saw that area. So I just kind of look at this, and if you kind of juxtapose this with the budget deficits, right, during these periods, how they expand massively, and we've seen the budget deficits in each recession get larger and larger as a percentage of GDP. I kind of feel like this chart probably looks more like the 1990 experience or more, and so. Look, I like the work that Goldman does, but I'm afraid here that just given that the trend here is not as good as it looks because of that 2020 massaging.
So here is a range of price on the S&P relative to, and this uses the Goldman down 11%. And we'll just use that since we have it here on this chart. Could be worse. And on the left-hand side column, you see the forward PE multiples. And when you go into recessions, you're not at 17. We're about 17 right now, right?
Yep.
Usually you fall down into the either high single digits, low teens. And so not surprisingly, everyone's got this kind of like 3,000 number out there, which is kind of expecting that, earnings kind of are flat and you go into a recession and we get down to that, 3,000 area, and that's kind of circled here in Goldman, and that's their baseline.
Yeah, and it seems reasonable, and I just feel like we're range bound on the S&P going into next year or two. But it's a wide range, right? I think we're close to the top of it right now. The sentiment was so negative. I mean, that's why I think you got some of this rally, and also you've had a relief in rates. Don't forget, and so that's one thing.
Meaningful relief in rates.
Yeah,
I mean, the 10-year's down. Roughly 75 basis points from its highs.
Right, and the long bond's down even a little bit more too. And so I think you're getting different signals from the marketplace here too. And so, maybe that multiple doesn't reset as low as 12. Maybe it goes more kind of like that average of like 14 to 15. And so that's where people are coming up with this kind of 3,000 target here if we get to that level. So again, I think it's a tradable range at this point. Just given that there's a lot of dynamics going on, what I think is the most important thing right now is how the market is rebuffing what the Fed's telling you. They're saying, no way, Jay, right?
Yeah.
You're not going to be able to deliver on your path of interest rates, and so
it was probably the most muted move in the bond market that we've seen after a Fed meeting this year.
Well, I think what's happened is, I saw a strategist, Dave Zervos, put out this morning like peak Volcker out there, and what he was saying is just, the sentiment was so negative. They're just waiting for the Fed to stop hiking. And I think you get a relief rally there, but then I think reality sets in.
That rates are really high still.
That rates are really high still. It's going to cause a slowdown. But, kind of the wild card here, we come back to corporate America, and we talked about those bailouts, or the amount of money we sent them in 2020, but also think about how much was refinanced. And so my kind of question coming into 2023 is that if you think about, how much was refinanced and the rate move we've seen, you look at coupons on corporate bonds, they're very low. So interest coverage is not really a significant problem if the E's okay. So maybe those long and variable lags are longer to the corporate market right now because there's not this need to refinance. Maturity walls are extended out.
You could also argue that the consumer is also less interest rate sensitive because in the U.S. we have a lot of 30-year fixed rate mortgages and a lot of borrowers have locked into very low cost of funding as well.
Right, and I know you put a chart together recently that shows that, where it shows that essentially the effective mortgage rate, or what the average person is paying today, is in the low 3 handle. So even though we talk about this 6.5% mortgage rate. And by the way, mortgage rates are way too high relative to the 10-year.
Yeah,
right.
They should come down.
They will come down if we stay in this range. I mean, you shouldn't have a 300 basis point spread, but they have it because of the volatility and the concern about it. But if you think about that, it's very important too to realize that most people that have a mortgage are way out of the money from these levels today, and therefore that burden has been passed on. Now, obviously prices are set at the margin. That's why, again, there's the forecast for housing to go down. But at this point, I think maybe the consumer can stave it off. Maybe it takes a little bit longer. But if Jay is committed to getting to terminal and staying there, it will bleed into the economy. So even if we don't have a 2023 recession, which seems very likely, if we're staying at those high levels of rates, it will bleed into the economy. It will hit the consumer. So maybe those long and variable lags that the Fed talks about
a little bit longer.
Are longer because of the setup we have today.
Okay, so we looked at the broad market. This is looking at the different subsectors of the S&P, talking about there's value to be had in sector selection into whatever environment you're going into, right? And so energy still looks cheap.
Yeah, I mean, there's a lot on that E.
Basis.
There's a lot in that E to get you to that point too. We'll show some other metrics on these too to show kind of historically where that looks like. But I think
some are usually lower than others, right? Like tech is always a little bit higher. It does have more growth, so it should be. You should pay up for that growth,
right? But historically too, utilities is one that's very cheap, right? And so it trades cheap for a reason, right? It's a highly regulated industry. It's a low beta kind of sector of the market. It's higher dividend, but look at what people are paying for it right now because that defensive trade. And so that's something to watch. That maybe at this point, some of these PEs are still very rich.
Yep. So another way to look at the market outside of PE is the CAPE ratio, which is something that you are very fond of.
Yeah. Well, I mean, so we talked about the looking at 12 months forward. You can always look in the rearview mirror, and so there's a lot of there's a lot of divisiveness about the CAPE ratio. There's the critics of it to say, well, it's been extremely elevated, therefore it doesn't work. But come back to my thesis from before: fundamentals come home to roost. Right, but technicals drive markets in the short term. And so what you see on the screen here is essentially applying CAPE ratios to sectors of the market. And it's a noisy indicator. If it was a great indicator, everybody'd use it. We'd just retire and we'd all just make money on the valuation. But you see it's noisy. We draw a regression line inside of there. But what this is showing is just two sectors of the market. And it shows that they still follow that pattern during periods of high valuation. So that's the horizontal axis shows the CAPE ratio of the sector. You get higher returns, right? So that's the vertical axis. And so thinking about that, when you have lower valuation, you should expect higher returns. When valuation's above average, you should expect below average returns. Just, that's what fundamental analysis shows you. And so it's noisy. We should draw the regression lines in there. But you can see the relationship holds at the sectors. And so looking at the next slide, one other way to think about that, and you pointed this out, right? Some sectors just inherently trade richer than others, right? And so if you apply the CAPE ratio to sectors of the market, what you'll find is that tech tends to have a higher multiple than utilities. Well, if you don't believe me, look at the screen, right? You can see on the left-hand side. And so notice here too that utilities are significantly cheaper than tech, but they always are in this ratio. And so one way to think about that and use the CAPE ratio to try to deduce valuation is compare each sector's CAPE ratio to its own history. And the reason you do that, just like Professor Schiller did, in his seminal paper when he looked at the market, you compare it to history and you say, is it cheap or rich? And so even though you see, tech is screamingly expensive on the CAPE ratio on this side, on a relative basis, it's actually cheaper than utilities. Again, because of that sentiment and the way that people think about, paying for a dollar of earnings. And so now juxtapose what we showed on the forward PEs. Look at the CAPE ratios here. And so what we're showing are relative CAPE ratios. So it takes each sector's CAPE ratio and compares it to its history. And so you can see here that, one, we had to expand the axes a couple of years ago because of the energy boom that we've seen here. But notice too that there's periods where all the sectors are roughly below their long-term averages. There's periods where you have a lot of kind of dispersion across sectors of the marketplace. And look at communication services. I mean, it's just been getting walloped, right? The valuation was relatively high, but it looks really, really cheap. And so we have strategies that obviously, use this process for allocating capital across sectors in the market. And so what's interesting is if you use this process that we do, and this was developed by Professor Schiller, where you look at those relative CAPE ratios and you say, okay, which are the cheapest parts of the market? So just go back real quick. It tells you comm services, financials, real estate, tech, and discretionary. Those are on the cheaper end of the market.
And energy, which we saw on the last page, that is deceivingly looking cheap because the PE is low, but when you compare it to its own history, now it looks expensive.
Right.
It's run up a lot.
It's run up a lot. I mean, you saw it up 50+% this year, and oil prices are flat.
Yeah, there's actually JP Morgan was out recently with a tactical short on energy.
Yeah, especially relative to the commodity. I mean, even if we get, oil prices back to like a 90 handle or 100 handle, again, on that, it would be predicated on that reopening of China. It seems like, again, that E is way too aggressive in that multiple. And so the process we use, it looks at the 11 sectors. It takes the 5 cheapest and it says, look, let's take a look at those 5. And so you want to allocate capital to those, but you get worried about, energy was a value trap back in like 15, 16, and 17. And so comm services is a value trap right now. So what it does is, of those 5 sectors, whichever one has the worst momentum within it, it extracts that one and you're left with 4. And so you allocate across that. And it's been a strategy we've used for a long period of time. And when you think about it, you say, okay, does this make sense? So one way we thought about it too is that, okay, if you say, okay, when do you allocate to a sector during this process? What's the performance? And then if you're not allocating to that sector, either because of the valuation like energy or the momentum like the communication services day, what does that look like? And what you have is the blue bars say when you allocate to the sector, here's the performance of the sector. And when you don't allocate, that's the black bar or gray bar that you see on the screen.
And this is going back to?
This goes back to 2002.
Okay.
Right? And so you create a time series of when it allocates, you create the time series of when it doesn't allocate, and you report the results. And so what you see here in general is that when it allocates to the sector, it does better. Just what we're talking about, right? If you have a lower valuation, you should have a higher rate of return. And so there's just something really interesting about this process that allows you to do it. And if you look at communication services, for instance, though, that's one where that's the momentum play, right? And actually financials would be the momentum play of kicking that out in like 08. Even the energy complex, the difference in those returns, that's even with this massive return this year where we haven't been allocated to it. Look at the market difference in performance. And that's because of that momentum and drawdown as well. So there are ways to kind of capitalize on this, even if you have a range-bound type of market. By being able to rotate, it allows you to try to outperform.
Because you have sectors that kind of change their leadership throughout the year, and so this way you can kind of try to buy on the cheap and rotate out after it's had a good run. Right?
That's absolutely right. And so again, we know that sectors, the valuation tend to mean revert over time, or at least they tend to trade closer to average. Yes, the E grows over time, but when you look at it, not all sectors do the same. And this type of strategy is predicated on dispersion. Right, you need dispersion to do it. It's a good thing. There's gonna be times you're gonna miss parts of the market, but in general, the process is one we highly believe in. And so, what does it look like? This is a very compelling chart here. And so, there's a shaded area where the data's live. There's a back test that goes back another 10 years prior to that. But if you look at just this process, the blue line is the process, right? So obviously it goes up and to the right, like everybody likes to see. There's the S&P in the middle. But we call we created another time series that says, don't follow this process. Do exactly the opposite, right? So when you're not out, when you're out of these sectors, let's create that time series. So you weekly weight them just like it's done in the other process. And notice that black line, right? It underperforms. But if you look at the data table too, it actually has a higher volatility, right? And so some of this is just avoiding what is expensive, right? Yeah. And we all know it, but there was the meme craze, right, in 2020. There was the FOMO, and we joked about it on your show here. But what you find is that stuff, just the fundamentals will come home to roost. It may take a lot longer than you think, and so a lot of people just have been dissuaded about the value side of the equation, and they had the FOMO out there. But this shows you that sticking to a process, avoiding that valuation, looking for the cheaper things can do significantly better. And maybe it doesn't look like it on the chart, but if you compare the process to what you actually see if you don't follow or you do the anti-process, 12%, 12.3 versus 7.2. I would say that's a market difference.
Yep.
Right. And so it's a huge thing to be able to avoid.
Is there a reason that there was more dispersion kind of post GFC, or is it like a scale thing?
This is a logarithmic scale.
Yeah.
So just because you're compounding, it's still going to be there. But the log scale, it's the slope of the line. So really, the dispersion is just those growth rates. And so because it's a logarithmic scale, the slope of the line is the growth rate. And so it's just you have a higher growth rate than the other. So yes, over time, that gap widens.
Yep.
And so just kind of lastly too, I know a lot of people focus on value versus growth too. And it's like, I'm either going to be a value investor or I'm going to be a growth investor, or I'm going to try to time it. And I say, why not do both, right? And so again, this is kind of repeating the data from before, but we had some kind of regression statistics in there and show that you still have high correlation to the market. People think there's going to be massive volatility if you only own 4 sectors. There's times where you own 4 value sectors. There's times you own 4 growth sectors. There's a lot of times where you own a split combination of them. And so again, when people say, well, do I want value? Do I want growth? I say, why not both, right?
Yeah.
And so again, if you can get alpha through this process, and again, I believe in that alpha coefficient through time, it's a very, very strong process, because ultimately what you're trying to do is just find something you can stick with, right? And so, if you're not a market timer, if you don't want to do the rotation yourself, it's something we can help you with.
Yep.
Yeah.
Trying to keep it short and sweet, short and sweet. So thanks for coming on. We talked about stocks today. We talked about bonds last time. Tune into the last episode to learn about opportunities in fixed income. We'll probably start next year with some guests with their market forecast for 2023. And everyone hopes it's going to be a good year, but I think it's going to be maybe a good year for bonds, but choppy for equities.
I think it's going to be a little challenging year. And like I said, we're all looking at kind of that money flow data too. And I think a lot of people are hoping the calendar year changes something. And unless you change a lot of sentiment, you change the money flow, it's going to be a little challenging. But look, the bond market carries right now. I think, right now credit looks better than the equity market on a risk-adjusted basis. But again, we still have to own stocks for the long run, right? It's what Mr. Siegel told us. And so, keep up the good work, Ken. Look forward to seeing your guests in 2023.
All right. Thanks, everyone. Happy holidays.